Hello and welcome to this walkthrough of the ACCA F6 UK taxation paper brought to you by ASWATAX. My name is Omar Aswat. Now for this video we'll be looking at the September-December 2018 paper, question 33, so a 15-mark question, and this question particularly looks at corporation tax on companies. 15 marks. We have 3 companies, so the marks are divided into 4, 6 and 5. And as usual, we shall read the question, analyze the information provided, work through together on the answers, and hopefully I will provide any further relevant information that is required for you to get that ultimate pass. Now, as usual, I strongly advise you to have a printout, if not a printout, at least on a device in front of you, the adapted question paper we have provided, and this will help maximize your learning and your knowledge. Don't forget to like this video if you found it of use, if you found it beneficial. Comment with any questions, your thoughts, your queries. Share with those who may also benefit, and subscribe to our channel. Most importantly, don't forget to visit our website where we have loads more videos and content available for you on demand. Now, this question we shall, as usual, read through the notes, and I advise you in your exam to read the question twice at least, and if not 3 times, because it is important in order to answer the questions efficiently and correctly, keeping up with the time constraints. You need to understand what is going on in the question. So, but we'll be taking this question a bit differently just because it is strictly split out into 3 separate questions or 3 different elements. And we are looking at ASH Limited, Beech Limited and Cedar Limited. So you have questions, separate questions on each of the companies. So we'll have a look at the questions separately as well, rather than reading through all the information and then answering on the different companies. We'll do them individually, separate them out. So you are the trainee chartered certified accountant assisting your manager with the tax affairs of 3 unconnected limited companies: ASH Limited, Beech Limited and Cedar Limited. ASH Limited was incorporated in the UK on 1st December 2018. So with taxation, dates are always important. Even if you think it's not important, somehow there's always a chance that it will be important. So incorporated on 1st December 2018, immediately opened a non-interest bearing bank account. Now, the reason I'm highlighting that, I'll come back to it in a second. The company commenced trading on 1st Feb 2019. That tells me the 18-19 tax year, preparing its first accounts for the 14-month period ended 31st March 2020. 1st Feb 19 to 31st March 2020, 14 months. Accounts were then prepared for the year ended 31st March 2021, so back to a yearly basis. At the date of incorporation, all 3 of ASH Limited's directors, who each own 1/3 of the company's ordinary share capital, were based in the UK. All 3 directors based in the UK. However, on 1st of October 2020, partway through the 2021 tax year, 2 of the directors moved overseas. The directors have always held ASH Limited's board meetings where in the UK, and will continue to do so despite 2 of them moving overseas. So for part A, what we need to look at is 2 elements. Identify ASH Limited's accounting period throughout the period 1 December 2018, so at date of incorporation, to 31st March 2021, that's for 2 marks. And explain ASH Limited's resident status throughout the period, again same 1 December to 31st March 2021, again for 2 marks. Now, just a bit of background before we get into the answer. Individuals, so sole traders, partners within a partnership subject to income tax, would be taxed differently and have different accounting period rules to companies who are subject to corporation tax. So always keep that in mind. Companies have different rules when it comes to accounting periods, assessable profits, basis periods. So with individuals or partners in a partnership, you have the overlap profits that come up. You have the second tax year, always tax 12 months, actual basis, current year basis. With companies, the first rule that you need to remember is for corporation tax purposes, you are only required to register once the company begins to receive any sort of income. Okay. Now we saw here that on incorporation 1st December, they immediately opened a non-interest bearing bank account. Therefore, that's not a source of income. They have not obtained a source of income, therefore not liable to CT yet. A few general rules when it comes to accounting periods for companies is that an accounting period for corporation tax purposes begins when the company obtains its first source of income, and a key rule to remember is for a company, an accounting period cannot exceed 12 months. That's the key disconnect with personal tax. For corporation tax, an accounting period cannot exceed 12 months. Now, in terms of ACCA Limited's accounting periods, throughout the period 1 December 2018 to 31st March 2021, 1st of December 2018 open, incorporated does not mean anything for corporation tax purposes. Non-interest bearing bank account, have not obtained a source of income, therefore nothing yet for corporation tax. However, they began to trade on the 1st of Feb 2019. Tax years are not relevant. They began to trade on 1st of Feb 2019, and the end of the period of account was the 14 months to 31st March 2020. However, an accounting period for corporation tax purposes cannot exceed 12 months. Therefore, the first accounting period would be from 1st of Feb 2019 to 31st Jan 2020. That will give you 1 mark to identify that. The second accounting period would be from 1st of Feb 2020 up until the end of the period of account, which was 31st March 2020, and the final accounting period up to 31st March 2021 would be from 1st of April 2020 to 31st March 2021. That will give you 2 marks in total. The second part, explain ACCA Limited's residency status throughout the same period. Well, it was incorporated in the UK, and therefore the company is UK resident throughout the whole period 1st December 18 to 31st March 2021. The move overseas by the directors is completely irrelevant. The directors and the company are completely separate legal entities. Doesn't mean anything what the directors do. And primarily because the board meetings are held in the UK, and I'm assuming they have a permanent establishment in the UK, the company will still remain UK resident, and that would be for 2 marks. The second part of the information in the question, and part B for 6 marks, is relating to Beech Limited. So the summarized statement of P&L for the year ended 31st Jan 2021 is as follows. We have gross profit 565,800, operating expenses depreciation disallowed by statute relates to capital expenditure, that will definitely be an add back. Gifts and donations 4,600, impairment loss, leasing costs and other expenses all having notes. And then we have finance costs, interest payable with note 5, profit before taxation of 305,500. As I say, try having the question in front of you, because when we're doing the workings, when we're looking at the answer, it'll be good to have that in front of you as well. So note 1, gifts and donations of 4,600 comprise gifts to customers, pens costing £70 each and displaying Beech Limited's names 3,500, qualifying charitable donations 1,100. So looking at that, gifts to customers are generally disallowed, so by default disallowed, and only allowable if they cost less than £50 per recipient, or not food, drink, tobacco or vouchers for exchangeable goods, and carry some sort of advertising. So now we've got advertising, we've got the pens, it's not food, drink, tobacco, etc. But it costs £70 each. 3,500 would be an add back, disallowable. Qualifying charitable donations does not relate wholly and exclusively to trade. Therefore, that would by default be an add back. However, for corporation tax purposes, if there are enough profits available, then you can potentially get a deduction as a qualifying charitable donation. But when working out tax adjusted trading profits, not wholly and exclusively for trade, therefore add back. Note 2 is the impairment loss. On 31st Jan 2021, Beech Limited wrote off an impairment loss of 3,700 relating to a trade debt. Definitely allowable Why? Because it relates to trade. This was in respect of an invoice which had been due for payment on 15 October 2020. That's completely fine. Note 3 is leasing costs. So the leasing costs of 12,600 are in respect of 4 motor car leases which commenced on 1st Feb 2020. So the accounting period began 1st Feb 2020. So that's for the full year. The cars available for the full year. Each of the 4 leased motor cars has CO2 emissions of 160 grams per kilometer, exceeds 110 grams per kilometer. Therefore, only 85% of the leasing costs would be allowable. 15% would be disallowable. Therefore, 12,600 times 15% would be an add back. If it was less than 110 grams per kilometer, then 100% allowable. Not the case here. 160 grams per kilometer, 15% of 12,600 is an add back. Note 4 looks at other expenses. The other expenses of 217,700 include a fine of 6,400 for a breach of data protection law, legal fees of 5,700 in connection with the renewal of a 15-year property lease. The remaining expenses are all fully allowable. So 2 items we need to look at. 6,400 for a breach of data protection law, definitely an add back. You don't get any tax relief for getting a fine. And legal fees of 5,700. The leases on a property would relate to capital expenditure by default. Therefore, capital expenditure is an add back. However, the renewal of a lease which is less than 20 years would be fine. So that's just one of them anomaly, an oddity rule that needs to be remembered. So legal fees in relation to the renewal of a 20-year or less lease would be fine. It'd be allowable. Note 5 looks at interest payable. The interest payable of 7,000 is in respect of the company's 4% loan notes, which were issued on 1st July 2020. Interest of 6,000 was paid with an accrual of 1,000 provided for at 31st Jan 2021. The loan notes were issued in order to finance the company's trading activities, trade related. Therefore, the interest payable is fully allowable. Capital allowances. No capital allowances are available for the year ended 31st Jan 2021. So no capital allowances, disregard. Required, calculate Beech Limited's corporation tax liability. Okay, liability, not the taxable total profits or anything like that. We are looking at the actual liability. So we're looking at 19% potentially. For the year ended 31st Jan 2021, note your computation should commence with the profit before taxation figure of 305,500 and should also list all of the items referred to in notes 1 to 5, indicating by the use of 0 any items which do not require adjustment. So anything that we've seen, any figures, any information, we'll have to make some sort of disclosure about it. And if it does not require adjustment, we just use a 0. And that is for 6 marks. Okay, so for 6 marks, we need to work out the corporation tax liability for Beech Limited, and I suggest that you have the question paper printed out in front of you or on a device. So we have been told that our computation should start with the profit before taxation figure of 305,500. So that's what we shall do, 305,500. Depreciation, we said, is disallowed by statute, relates to capital expenditure. You would get relief via capital allowances. So we'll add back the 14,700 and we'll just make a note saying disallowed by statute, relates to capital expenditure. You won't have to know that in the exam, but it's good for your knowledge purposes. Gifts to customers, we said, is disallowable as it costs more than £50 each, £70 each. So 3,500 would be an add back, as well as the qualifying charitable donations of 1,100, 3,500, 1,100, and just make a note for that, saying that it would have been allowable because it's not food, drink, etc., and has some advertising. However, exceeds £50 per customer, therefore the full amount is added back. Qualifying charitable donations, not related to trade, but can get deduction further down the comp under CT rules, provided that there is profit available. Impairment loss, we said the 3,700 relates to a trade debt, so we do not need to add anything back. Just put a note there saying relates to trade That's fine. Lease of motor cars, we said we will have 85% of the leasing costs allowable, 15% would be added back. Therefore, 12,600 times 15% would be added back. So we make that as a formula, 12,600 multiplied by 0.15. So therefore, what we're trying to say is the remaining 85% is allowable. Data protection fine. Add back, any fine is an add back, 6,400 would add back. Legal fees of 5,700 in connection with the renewal of a 15-year property lease, a short lease, is allowable. 6,400. And we don't add anything back for the legal fees. Let's just make a note for that, saying specifically legal fees on renewal. Okay, so sometimes they'll try to trick you and say legal fees on taking out a new lease of, let's say, 10 years. So it's still less than 20 years, but it has to be on the renewal of a short lease. Interest payable, we said it relates to the company's trading activities. No further adjustment required. So then we just tally that up. That gives us our tax adjusted trading profits of 333090. There are enough profits available. That's where we get a deduction for qualifying charitable donations. Taxable total profits, therefore, 331,900. Now the question is saying we need to work out the corporation tax liability. So we'll just put here corporation tax liability, and it would be 331,990 times 19%, which gives you 331,990. Get used to using these formulas. 19%, 63078.1 is the corporation tax liability. In terms of marks, you'd get half mark for depreciation, half mark gifts to customers, half for impairment loss, qualifying charitable donations. You'd get a mark for the lease, and everything else would be half a mark. Looking at that would give you 6 marks. The final part to this question would be looking at Cedar Limited. Cedar Limited is a 100% subsidiary company of Timber Limited. 100% subsidiary of Timber Limited. The following information is available in respect of the two companies for the year ended 31st March 2021. For the year ended 31st March 2021, Cedar Limited made a trading loss of 19,700. On 28th December 2020, in the 2021 tax year, not too relevant for companies, but still within the year ended 31st March 2021, Cedar Limited sold. As soon as you see the word sold, you are thinking, if it's for individual, you are thinking capital gains tax, disposal, or chargeable gain, disposal for corporation tax purposes. So disposal proceeds, sold, that's what the alarm bells should be ringing in your head when you see sold. Cedar Limited sold its entire shareholding of £25,001 ordinary shares in Forest PLC for £6 per share. So disposal proceeds would be 25,000 multiplied by £6 per share. Cedar Limited had originally purchased 20,000 shares on 1st July 2013 for 24,800. Base cost 24,800. And then on 20th July 2013, so a few weeks after original purchase, Forest PLC made a 1-for-4 rights issue. Cedar Limited took up its allocation under the rights issue in full, paying £1.15 for each new share issued. So they paid premium £1.15. Bonus issues, rights issue, they've taken it up in full and they've paid the premium 1-for-4. Therefore, if they purchased 20,000 shares originally, 1-for-4 would be an additional 5,000 shares at £1.15 for each new share. The indexation factor from July 2013 to December 2020 was 0.244. Just a note to make there is that we'd understand that to be up until December 2017. Okay, because in December 2017, the indexation allowance was abolished, so there is no indexation allowance post December 2017. For the year ended 31st March 2021, Timber Limited made trading loss and a capital loss of 2,800. There is no possibility of Cedar Limited or Timber Limited offsetting the trading losses against prior year profits, so there's no carryback. Section 37. So the group has a policy of utilizing losses at the earliest opportunity. That's the usual question when it comes to loss relief. Companies or individuals partners in a partnership, they look to offset losses earlier rather than later for many reasons. One is you can get a potential tax refund on whatever tax was previously paid. And secondly, there is no guarantee that profits would be available in the near future. What are we required to do? On the basis that all available claims and elections are made, calculate Cedar Limited's taxable total profits. So we are not looking at tax liability, no 19%. We're just looking at the taxable total profits for the year ended 31st March 2021. That's for 5 marks. So we need to calculate the taxable total profits. We can start with our disposal proceeds as per the question. You can have that as working one. And we said 25,000 shares sold at £6 per share. That gives you equals 25,000 multiplied by 6 gives you 150,000. Okay, the index cost, we'd need another working for that. Why? Because we have a few transactions that take place. So they had originally purchased the shares. So you can make up a share pool, shares and cost. Usually that's how you would do it. Shares cost, and it was purchased. 20,000 shares were purchased at a cost of 24,800. So this is as per the question information provided. And then we had a rights issue shortly after, which was 1 for 4 rights issue. So 1 for every 4 at £1.15 per share. 1 for every 4, what would that mean? 1 for every 4 means if you have 20,000 shares, 1 for every 4 means you divide it by 4 gives you 5,000 more shares issued, and those have been issued at premium. Par value was £1. These have been issued at £1.15. That gives you a cost of 5,750, and then you would have your total number of shares to be 25,000 with a cost of 30,550. Now we need to work out any indexation, and that would be 30,550 times by 0.244, again provided to you in the question. So we do 30,550 multiplied by 0.244. That gives you 7,454. And then we can add that together. Gives you 38,004. Okay, so our index cost is 38,004. I'll just put here index cost. And that gives you a chargeable gain of 111,996. We had the capital loss of 8,800 brought forward, minus 8,800. So the capital loss is relieved in priority against the chargeable gain. And then we have the group relief of 2,800. And we have the loss relief of 19,700. And that gives you taxable total profits of 62,696. In terms of marking, you'd get half mark for the disposal proceeds. You'd get 2.5 for this working here. So that's 3 marks. You'd get a mark to offset capital loss in priority, and then half mark between the group relief and the loss relief. That would give you a total of 6 marks. I hope that's all made sense. As always, if something has not made sense, go back and watch that part again. If you have any questions, don't be shy to email us or put your questions, comments down below. And don't forget to like this video if you found it beneficial. Comment with your thoughts and understandings. Share with those who may also benefit. And don't forget to subscribe. Also, visit our website where we have loads more videos like this that will help you gain the ultimate pass. Those videos are all available on demand. We shall see you soon. Thank you. Bye.